Here's what often happens. Someone retires in their early 60s, their paycheck stops, and they may not have started Social Security yet. And since RMDs from their IRAs don't begin until their early 70s, their income can actually be much lower than it was during their working years. The problem is, many retirees don't take advantage of this lower income window. They avoid doing Roth conversions because they don't want to voluntarily pay taxes today, so they wait. The problem is that by the time they finally look at Roth conversions again, their income picture has completely changed. As retirement progresses, several new sources of income often appear. First, Social Security benefits usually begin sometime in your 60s. Depending on your income, up to 85% of those benefits may become taxable. During this period, your IRAs are probably growing if the market is doing well, which it usually is. So by the time you reach your early 70s, your IRA balances have grown substantially, right when RMDs begin. Those withdrawals add taxable income every year, whether you need the money or not, and the percentage you're forced to withdraw only goes up over time. At this point, the tax picture often looks very different than it did right after retirement. Your income is likely higher, possibly much higher. Tax brackets fill up quickly, and Roth conversions become much more expensive than they would have been earlier in retirement. Let's illustrate with a simple example. Imagine someone retires at age 62 with a $2 million IRA. From age 62 to 67, they haven't started drawing Social Security yet. Their income might come from savings or a brokerage account. During those years, their taxable income might only be about $40,000 per year. That could leave plenty of room in their current tax bracket to convert part of their money from their IRA into a Roth. But many people skip this step because they don't want to increase their tax bill today, so they wait. Fast forward 10 years, Social Security has started, RMDs have begun, and now their income might be $150,000 per year or more, and it's only going to grow as their RMDs increase. At that point, while the IRA is still large, their tax brackets are tighter, Roth conversions become far less appealing because they'd have to convert at a much higher tax bracket. Now, one often overlooked element is how all of this affects Medicare. Medicare uses something called IRMAA to determine your premiums, and IRMAA can increase your Part B and Part D premiums once your income crosses certain thresholds. So higher income in your 70s can mean higher taxes and higher Medicare premiums. Avoiding taxes during those early retirement years can sometimes mean paying more taxes and higher healthcare costs across retirement. That's what I call a double whammy. So what do you do about all this? Well, the key idea is simple. Many retirees are not aggressive enough with Roth conversions during their early, lower income years. Those early years after retirement can be a valuable planning window. But because retirees don't want to increase their taxes in the short term, they pay for it heavily in the long run. Gradually converting some IRA money during those early years of retirement can reduce the size of future RMDs and create more tax flexibility later in retirement. But if those years pass without a plan, the opportunity can be difficult to recover. Now, Roth conversions are just one piece of the larger retirement tax planning puzzle. In my training called How Tax Planning Changes Through 4 Stages of Retirement, I explain how tax rules evolve across retirement and why certain strategies tend to work best at specific times. If you'd like to understand how those tax decisions fit together, you can watch the full training by clicking the link in the description below. Thank you again for watching today's video. I hope you enjoyed it. And if you did, please give it a like and subscribe to my channel to see more content like this in the future. Thank you again, and I'll see you next time. Hi, my name is Justin Haywood, President and CEO of Haywood Wealth Management. And if you're interested in learning more about how we help our clients live their life to the fullest, visit us at haywoodwealth.com to learn more. Thank you so much.